If you want to retire early, say in your 30s or 40s, the popular advice is that you should prioritize contributing to 401ks, IRAs, Roths, and other retirement accounts because they're assumed to be the best way to lower your taxes as you invest for retirement. However, this advice isn't always true if you want to retire early and can do so on a modest income. Imagine having the financial freedom to be able to quit your job and not worry about money. Maybe you want to take a mini retirement and travel the world for a year or forever. Maybe you want to financially support yourself to start that dream business. Maybe you just need a break from your career to take care of those you love. If you want to retire early to enjoy such freedom, you have to think differently about what accounts to use. In this video, I'm going to explain when you should avoid retirement accounts in favor of taxable accounts if you want to retire early. I'm going to walk you through specific examples where it makes sense to skip or minimize contributions to a retirement account. The benefits of taxable accounts are often underappreciated, but they offer the flexibility and simplicity that is ideal for early retirement. The fact is, each type of account is simply a tool to achieve a different goal. Retirement accounts, such as 401ks, are designed for those who plan to retire at the traditional age of 60 or older, and they are extremely effective at doing that. But if you want to live off your retirement account decades earlier, you either have to pay a 10% penalty in addition to the taxes, or go through convoluted and restrictive rules to take money out, like the 72T substantially equal periodic payment rule, also known as SEP, or create a Roth conversion ladder. Both the penalties and the rules make it a headache if you want to retire early off these accounts. It can feel a bit like fitting a square peg in a round hole. It just wasn't designed to be used that way. But maybe you're okay with playing this game, either by choice or necessity. However, if you live off a modest income, what you need to consider is that the value proposition of retirement accounts are underwhelming in a way that few people seem to recognize compared to taxable accounts. Now, I'm going to ignore anything in regards to employer matching because first, it's a no-brainer that you should contribute to your retirement account to at least get the full match. Never leave money on the table. Second, the employer match varies widely from nothing to 10%. So I'm focusing strictly on the accounts themselves and not company-specific benefits. So aside from that, the biggest reason you invest through a retirement account is to reduce your federal income tax. Broadly speaking, this is done in two ways. You can pay taxes when you reach 59 and a half using traditional 401ks or traditional IRAs and such, or you can pay taxes now when you use Roth versions of these accounts. But regardless of when you pay, the reality is it's a lot because you pay at ordinary income tax rates. Those rates shown here contain some, if not, the highest tax rates in the entire revenue code. You pay 10% of the very first dollar you earn and pay as much as 37% on the last dollar for those of you fortunate enough to be in the highest bracket. So basically, these rates determine how valuable your retirement account is through the tax savings. The higher your income, the more you save. The lower your income, the less you save. Before I go further, if you are interpreting this to mean you get a bigger or smaller refund when you file your tax return, you are not understanding how taxes work. A tax refund simply means you overpaid your taxes. What really matters is your tax liability or what you owe in taxes. Also, if you think that based on these tax rates, you pay 12% in taxes if your salary is between these numbers, that's not how you calculate your income tax liability. Let's say you make $70,000, and if we want to be real specific, let's pull out a 1040, the IRS individual tax return, and place that as line 1 here. You need to boil that down to your taxable income to get your tax liability. Taxable income is on line 15. To arrive at it, you need to adjust your $70,000 that belongs in line 1 through the 13 lines below it. As an example, let's just say you end up with $50,000. To get your tax liability on line 16, first you calculate 10% of the first $19,750 in taxable income, which is $1,975. Then your income between $19,751 to $50,000 is taxed at 12%, which comes out to $3,630. You add those up and you get $5,600 in tax liability. All right, now that we are on the same page about taxes and how to calculate it, let's first compare after-tax retirement accounts and taxable accounts. I'm going to specifically talk about Roth 401ks here, but the concepts should for the most part translate to other after-tax accounts like Roth IRAs. With Roth 401ks, you pay taxes before the money goes into the account at your income tax rate, and the benefit is that you don't pay taxes on the earnings if you take them out after you reach 59 and a half. If you withdraw your earnings before then, you need to pay taxes and a 10% penalty. However, you can withdraw your contributions at any time without paying the penalty or taxes again. Now, taxable accounts are also funded with after-tax money, but the money you contribute can come from anywhere and you can put in as much as you want, whereas a Roth 401k can only be funded with your earned income up to $19,500 if you're less than 50 years old. Another key difference is that you can withdraw the contributions and earnings whenever for any reason, but you only pay taxes on your realized earnings or gains, regardless of whether you take the money out of the account or not. This also goes for dividends and any interest income. But the biggest difference that matters most if you want to retire early is that investments in taxable accounts, if held for more than a year, are taxed at the more favorable long-term capital gains rates shown here, which are much lower, and the income brackets are much broader than the ordinary income tax rates. In fact, assuming you are married filing jointly or MFJ, you pay zero taxes on capital gains with taxable income as high as $80,000. And if you add the standard deduction for $25,100 for MFJs, you can earn up to $105,000 purely in capital gains and or qualified dividends and not pay any federal income taxes. So with a Roth 401k, your investment gains will grow tax-free, but you don't want to take it out until you're 59 and a half, which doesn't help you retire early. However, with a taxable account, you can live off of it for as much as you need at any time, and your withdrawals, if you held an investment for more than a year, are tax-free as long as your total taxable income is under $80,000. So if you can retire early by living off at most a taxable income of $80,000, then contributing to a Roth 401k doesn't really make sense compared to a taxable account. A Roth 401k doesn't offer you any additional tax benefits that you can't get with a taxable account, yet the taxable account is much more flexible. Plus, whatever fund you want to invest in a 401k plan can most certainly be found in a taxable account with more choices available and potentially at cheaper cost. So if you're interested in getting started with a taxable investment account right now, Webull offers 2 free stocks worth up to $1,850 for opening a taxable account and depositing $100. Webull is an online trading platform that is commission-free, no minimum deposits, there's no cost to use a basic service. So you can try it out and get free money just by signing up and making a deposit. So claim your 2 free stocks now by using the link in the description, and by doing so, you also help support this channel, so thank you. Now, before we move forward, it's crucial you understand how capital gains tax rates work in relation to income tax rates. For example, if you work a $50,000 job, and then realize $80,000 in capital gains or dividends because you think it won't be taxed, you're going to be disappointed. Your income sources are not taxed separately like that. Here's how it would work, and let's just say $50,000 is your taxable income from your job to keep it simple, and again, we are assuming MFJ. If this bar represents your total taxable income, your job will bring you up to $50,000. This portion of your income is taxed at the normal earned income tax rate. So you owe $1,975 on the first $19,750 and $3,630 on the income above that to $50,000. And then you add the $80,000 from capital gains on top of that. So the first $30,000 is tax-free and $50,000 remaining is taxed at 15% according to the capital gains rate. So the bottom line is, if you are able to live off a modest income in early retirement and take advantage of the capital gains rates, you should consider contributing up to your employer's match and then put the rest of your money into a taxable account. But if you have kids, the shocking thing is pre-tax accounts, and specifically a traditional 401k, might be better because of the Earned Income Tax Credit or EITC, and I'll get to that in a minute. And so with that, let's talk about pre-tax accounts versus taxable accounts. Which one is better if you want to retire early? And here, surprise, surprise, I'm going to use a traditional 401k as our pre-tax account. Unlike a Roth, contributions to a traditional 401k will give you immediate tax savings that taxable accounts do not. For example, if we look at 3 different income levels, $50,000, $70,000, $150,000, and let's just say you make a 10% 401k contribution. We need to get to the taxable income to determine the marginal tax rate to calculate the tax savings. So we subtract out FICA tax first at 7.65%. That's for Social Security and Medicare. Then we subtract out the pre-tax contributions, and we are ignoring state and local taxes and any paycheck deductions to keep things simple here. We get these pre-tax income amounts, and assuming that these are our adjusted gross income or AGI, and assuming we are filing MFJ, we subtract the standard deduction of $25,100, and we finally arrive at our taxable income. Now, referring back to the income tax brackets, 10% contributions at each taxable income level means we save 10% at $50,000, 12% at $70K, and 22% at $150K. So at each level, the initial value of the 401k is $500, $840, and $3,300. Now you need to pause here and consider, are these savings worth it to lock up your money for decades? if you want to retire early. And don't forget that you still pay income taxes on this whenever you take it out or convert to a Roth. So these savings will be reduced. But we have a slight problem. The critical information we need to know but don't have is your future marginal tax rate when you move the money out and pay taxes. Because of the deficit and the massive government spending as of late, most people predict tax rates will go up, but the question is for who? If rates go up, obviously you are better off paying taxes now by choosing a Roth or taxable account. And it's very possible that this might be the case if Congress does not extend beyond 2025 the most recent tax cuts as part of the Tax Cuts and Jobs Act of 2017, where tax rates declined in 5 of the 7 brackets. Or Congress might extend them, and if that were the case, and we ignore differences in total investment returns because of tax differences, it comes back to a question of how much do you need to live off of in early retirement. But there's one loophole that might tip a 401k in your favor, and that is again the EITC. Here's how this works. If your income is within range of these EITC's thresholds based on the number of kids on your tax return, you can contribute to your pre-tax 401k, reduce your income on the 1040, and be eligible to get the EITC credit or more of it. More importantly, the EITC is a refundable tax credit, so even if you have no tax liability, you'll still get the money. But these income thresholds aren't exactly high, and maybe you need the contribution money within a year or so to pay your bills. In that case, the EITC credit may be bigger than the 10% early withdrawal penalty you'll need to pay, which means you could take your contribution money back out, pay the penalty, and still come out ahead. Let's consider 3 different contribution scenarios, and let's assume your household is making $55,000 as 1040 line 1 and AGI. You file as MFJ, and you have 2 qualifying kids. First, you make no pre-tax contribution to your 401k. Second scenario, you make a $5,000 contribution. And third, you make a $10,000 contribution. The max earnings to be eligible for the EITC in this situation is about $54,000. So the 2 contributions effectively reduce your income, making you eligible versus not contributing. Based on an EITC calculator, your credit is estimated to be as follows for each scenario. These credit amounts are higher than the early withdrawal penalty, which is again 10%, that you would pay to take all the contributions back out. Which means if you made these contributions, get the EITC credit, take the money out, and pay the penalty, you will come out ahead. Now, a $10,000 contribution may be unrealistic, but it is just to illustrate how the difference grows the bigger the contribution. Raising 2 kids off a $55,000 income is no easy feat, but the EITC offers a tax strategy that makes pre-tax contributions worth a second look. But there's some key details to keep in mind. First, the EITC provides very generous tax credits, shown here based on the number of kids you claim on your tax return, your filing status, and your earnings. The maximum credit is available for those filing MFJ with earned income and AGI up to about $25,000, and then it gradually phases out at about $57,000 for joint filers. While that may be really low for some of you, the median household income in the US was just $69,000 in 2019, so many families are within striking distance of the EITC, but they simply don't realize it. Second, if you want to get your income under the threshold, both your earned income on line 1 and AGI on line 11 need to be under the income limit, so a traditional IRA is not going to work because it won't reduce your line 1 amount. IRA contributions are deducted further down on line 10A as part of the Schedule 1 form. So you have to reduce your amount at the top, and that is why a traditional 401k or even an HSA would work. So the bottom line is you need to run your numbers, see if you can get the EITC or boost the amount you already receive by making pre-tax contributions. From there, you can keep your contributions in your retirement account or do some more math and see if you can come out ahead if you take it out and then you can invest it in a taxable account. But unlike retirement accounts, you must be very careful about taxes. You could lose a lot of money because you are now exposed to taxation. So here's 2 really important things to consider. First, always avoid investing in mutual funds in a taxable account. Find an ETF version of the mutual fund and invest in that instead. ETFs are much more tax efficient than mutual funds because of how they are structured. Mutual funds have to buy and sell positions when investors buy and sell the fund, which incurs a lot of capital gains taxes, whereas with an ETF, The ETF shares are exchanged on the secondary market and no positions are bought and sold by the fund itself. I'll leave a link to a Morningstar article down below that explains this in greater detail. Second, be careful about investing too much in stocks that pay out ordinary dividends. Ordinary dividends don't qualify for the lower long-term capital gains rates that qualified dividends do. If you're going to live off purely on dividends, the standard deduction, like the $25,000 for joint filers, allows you to shelter that much in ordinary income before you start getting hit with taxes. And this is true of payouts from covered call ETFs, REITs, and other high-yield investments. If you enjoyed this video, be sure to hit that like button below, subscribe, and hit that notification bell so you don't miss out on any future videos. Thanks for watching, and I'll see you guys next time.